If you're brand new to investing, or maybe you haven't even started investing yet, or just been investing for a few years, then today's video is going to be perfect for you, especially if you're someone in your 20s. We're going to talk about how you, number one, open a portfolio, start funding it, but from there, where do we even start? What do we start investing in? We're going to cover all of that. And the thing that you have at your advantage being in your 20s is you have a much longer time horizon. It allows you to take some more risks because of that time horizon. Many of the investors that I work with within my 6-week investing accelerator course, one thing that they always say they wish they did was start sooner. So we're going to get you started. If you're in your 20s or even if you're in your 30s, this video is going to be perfect for any beginner investor. So with that being said, before we jump in, do me a huge favor. Click that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels, especially new investors. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into today's video and let's begin by discussing time horizon. When you're just started your investing journey, and especially if you're in your 20s or 30s, you need to understand that time is your friend. It doesn't matter when it comes to investing, starting with a large sum of money. A lot of people come in and say, hey, I only have a couple $100 to start investing. That is perfectly fine. When I have new investors that I'm working with on a weekly basis, I tell them, let's start by building the habit. I don't care if you're investing $50 a week, or if it's $500 a week, or if it's $1,000 a week. I don't care what you have. When we start, I want to start building the habit. And the habit doesn't start by saying, oh, okay, I go through my weekly budget or my monthly budget, and whatever I have left over, that's what I'm going to invest. No. Let's make a line item within our budget and make investing a priority. Again, investing isn't about what's left over. Investing should be made as a top priority if you're serious about building long-term wealth. So let me show you an example of how investing a certain amount of money every month could help you reach your goals. We're going to take a look at a compounding interest calculator just to give you an idea. Looking here at this compounding calculator, which I'll leave a link down in the description below, this will show you how investing a certain amount of money at an average return can generate huge amounts of wealth over the long term. In this example, let's say that we start with $500 and we're going to invest $500 every single month into our portfolio. We're 25 now and we're going to invest until, let's say, 55. So we're going to invest for 30 years. The average return for the S&P 500 for a number of decades now has been between 9 and 10%. So in this example, let's use 9.5%. And now we're going to run our calculation to see in 30 years, where would our portfolio be if we continue to invest $500 per month, if we got an average return of 9.5%, we would have a portfolio of roughly $905,000. Now let's say we just increased that by $50 and we went up to $550. We started with $550 and then we're going to add $550 per month. We calculate that and we're talking about a portfolio now that is on the doorstep of $1 million just over a 30-year period and just earning a 9.5% average return. Now, we just went through 2023 where the S&P 500 was up over 20%. We are just trying to average 9.5%, and that's a total return, including dividends. So now let's go back to our calculator, and let's say we have a little bit more that we're able to invest on a regular basis. Let's say that we start with $1,000. We start with $1,000, and we're able to add $1,000 every single month. Now, again, this is an estimate. So maybe you start lower, and maybe you surpass $1,000, but we're going to average right around $1,000 per month over a 30-year period. We're going to keep the same 30-year length of time. We're going to keep the same exact average return of 9.5%. Now let's calculate that and see where our portfolio could be in 30 years. We are talking about a portfolio of roughly $1.8 million right there. If you can start at a young age and put as much as you can towards investing. I know investing isn't the cool thing to do at a young age, and I too wish I started earlier. But if you can do this at $500, at $100, just start building the habit and build upon, you can see what the potential is moving forward. Investing can be so powerful, and it can help you build that generational wealth. So if you're brand new to investing, how in the world do I get started, Mark? I don't even have a brokerage account. Well, let's go through a few steps here just to see how you, number one, open an account, but build the portfolio and reassess that portfolio moving forward. Beginning with step number one, let's open a new account with a brokerage of your preference. Find a brokerage you like. There's many of them out there. I use Fidelity. I have some money over in WeBull where I'll do some options trading out there. But there's big brokerages out there like Vanguard. Fidelity, I told you I use. There's E-Trade. There's even smaller ones that are great on mobile like Robinhood. Just find and look at the user base. How do you like all the different bells and whistles that they have? Where are you most comfortable? And open an account there. Step number one, we found a brokerage. Step number two, now we're going to open an account with this brokerage. You can open a taxable account, but you also want to look for retirement accounts because this could be the most tax advantageous way to invest, especially early on. For me, my number one priority when we go into a brand new year, every single year, number one priority is to max out my Roth IRA. When it comes to Roth IRAs, you're going to invest post-tax dollars, but all of that money from that day forward is going to grow tax-free. That means whatever that money grows to, if you see $1 million or $1.8 million in your account down the road, that is yours 100% to keep. Uncle Sam can't be coming asking for some cut of that moving forward. Other retirement accounts or tax-deferred accounts include things like 401ks, HSAs, and then moving on to a taxable account. So I have an array. I got a Roth IRA, as I mentioned. I have an HSA account. I have a 401k account. And then I have my regular taxable account. So find the account that fits you best. If a Roth IRA, if you are someone that believes that your income is going to continue to grow moving forward, you're only in your mid-20s or low 20s right now, or even late 20s, and your income is expected to grow exponentially through your working years, then a Roth IRA might be a great choice for you. Pay the taxes up front as you continue to climb the tax bracket ladder. You're going to already have money invested, and it's going to be growing tax-free. So step number one, find the brokerage that you like best. Step number two, let's open the accounts. Step number three now, let's fund those accounts. And you can set up automatic fundings each and every month. If it's $500, if it's $100 a month, you can set up automatic contributions from your bank account into your Fidelity account, into your Vanguard account, into your E-Trade, Robinhood, whatever it may be. This is the easiest way to make this a priority. And again, going into a new year, this is the start of 2024. My first priority when I make a contribution this year is going to be towards maxing out my Roth IRA. And the best way, again, to build that habit is by setting up automatic contributions. Now moving on to step number 4, which is develop a strategy. You never want to go into anything blind, especially investing. So the important thing you need to do, although you have money in your account, let's first develop a strategy. Let's understand what type of investor do you want to be. This is something I do at the start of every single 6-week investing accelerator course client that I bring in, where you can work with me one-on-one. If you're interested in this, there's a link down in the description below where you can set up an interview call with me to see if you're a good fit and find out some more information. But we develop a customized strategy. Everyone has a different strategy. Everyone has a different risk profile, how much they're going to be investing, what age are they starting, what are their long-term goals from that standpoint there. So let's develop a strategy, and we're always going to look back to this strategy. Every single stock, ETF, index fund that we invest in should match which type of investor we want to be. If your strategy is to be more of an investor that's geared towards passive income and taking lower risk, then you probably shouldn't have in your portfolio a bunch of penny stocks. If your strategy is to take on more risk and be more growth-oriented, then probably high-yield, slow-moving ETFs aren't really going to fit your particular strategy. So develop a strategy, stick to your strategy, and regularly reassess your strategy. Now what we can do is we can start investing. And that leads us to step number 5, which is building the core of your portfolio. When you're ready to make your first investment, number 1, it should fit your strategy, but number 2, it should go towards building out the core, the foundation of your portfolio. Regardless of whether we're talking about investing, health, a group of friends, relationships, family, whatever the case may be, it's important to have a strong foundation, something to fall back on when times get tough. And your portfolio is no different. So for me, when it came to building out the core of my portfolio, that came by way of an S&P 500 index fund. And that's still the case today, and it'll never change. If you were to open up my portfolio right now, you would see that same exact S&P 500 index fund that I look to build on a regular basis. And if you want to see my entire portfolio, you can head over to the Investor's Edge. I'll leave a link down in the description below where I publish monthly portfolio updates showing all my buys and sells for that particular month. By investing in an S&P 500 fund, whether it's an index fund or an ETF, something like SPY or VOO, this gives you a piece of 500 of the top companies here in the US. It doesn't give you exposure to all the companies in the US. That would be through an ETF called VTI, which is a total US market ETF. But for me and my way of investing, I like just the top 500. I want the 500 of the best companies to invest in those. I want higher exposure to those bigger companies. So let's take a look at the ETF sector breakdown. In this example, we're looking at SPY, but all S&P 500 ETFs and index funds are going to track the same index. So to no surprise though, technology is at the top, the largest sector with 29% exposure, followed by healthcare, financials, consumer cyclical, communication services, rounding out the top 5. Next, looking at this chart, you could see the top 10 holdings within the S&P 500, which include the likes of Microsoft, Apple, Amazon, Nvidia, Google, Class A stocks, Meta, Google Class C stocks, Berkshire, Tesla, and United Health rounding out the top 10. So the key first is to always build out the core of your portfolio. And a great way to do this is through ETFs or index funds. Think of them as a basket of stocks. And that leads us to step number 6, which is adding risk if you see fit. First and foremost, again, we're going to stick to our strategy. So if we do want to take some risks or some calculated risks and it's in the strategy, then let's do it. Risks or adding risk to your portfolio could be by way of ETFs still, or risks could be looking at individual stocks. By investing in individual stocks, you get that individual stock risk exposure. Think of something like Starbucks. The 2 largest markets for Starbucks are here in the US and then China. Since the pandemic hit back in 2020 or slightly before that, the China economy has struggled mightily. So that has weighed on the results of Starbucks. Although we saw the S&P 500 climb over 20% in 2023, that wasn't the case when it comes to Starbucks. And that's that single stock exposure risk you have when you invest in a single company. But there's ways to take more calculated risk, and you could do this through ETFs, as there is thousands of ETFs that are out there. ETFs stand for exchange traded funds. There's ETFs that we talked about that cover the S&P 500, very diversified, but there's sector-specific ETFs. It's going to give you diversification still by way of having a lot of different companies, but it's going to be more focused on a particular strategy. So there's ETFs that just track the industrial sector. There's ETFs that just track the healthcare sector or the technology sector, so on and so forth. But you could add risk by investing in small caps through an ETF called IWM. Or if you just wanted to invest in semiconductor stocks, you could look at an ETF like SMH. When it comes to adding risk to your portfolio, that's going to add a couple of things. It's going to add volatility, so you're going to have to be able to stomach that. Volatility is big swings up and big swings down. That's what individual stocks do a lot of the time. Think of a stock like Nvidia. In 2022, Nvidia was down 70%. In 2023, Nvidia was up well over 200%. How's that for volatility? However, again, as an investor in your 20s and just getting started, you have a much longer time horizon. You have the ability to take more risks right now. However, they say as you get closer to retirement, though, you need to take less risk and get much more focused on moving stuff out of the stock market and into fixed income, because you can't take those calculated risks and make up that money that quick when you're only, say, 5 years from retirement. So if you're in your 20s and you want to retire by 50, you have 30 years, a lot of time to take much more calculated risks. And that leads us to step number 7, which is automating your reinvestment plan. We already talked about earlier about automating your contributions, setting up automatic contributions from your bank account into your investing account. There's other ways to automate though. Once you get that automation set up, you can also set up automatic investments. Let's say you want to start building out that core position in an S&P 500 ETF like SPY or VOO. Well, you can set up automatic investing plans within your brokerage. Right now on Fidelity, if I add $1,000 into my investing account, 50% of that is going to go into my S&P 500 ETF. You can do the exact same thing. It's a much more hands-off approach to investing. Another way that you can automate things is by setting up a thing called DRIP, the Dividend Reinvestment Plan. This means that for any ETF or individual stock that pays you a dividend, they will take that dividend, you will collect it, but they will automatically reinvest it back into that same exact position. So now you're adding shares every single month or every single quarter, depending on when they pay you a dividend, without having to add fresh new money from your bank account. This is the true power of compounding dividends. So if your shares are going up and the dividend paying company or the dividend ETF is increasing their dividend every single year, not only do you have more shares the next year, but they're paying out a higher dividend income, which allows you to keep adding more and more shares every single year to your portfolio. So that there is a 7-step process on how you can launch your investing journey. Again, someone in their 20s has a much longer time horizon. You're able to take calculated risks if that's the type of investor you want to be. Everything leads back to your strategy. And you can reassess your strategy on a regular basis to determine, okay, do I need to take a little bit more risk, or maybe I need to dial it back a little bit and take less risk? Are you more of a passive income investor? Are you more of a growth conscious investor? Whatever it may be, just reassess your strategy, and every investment that you make needs to fit within your strategy. Again, if you're a high growth investor, maybe not the slow moving high yield ETFs are for you. Or if you're more passive, maybe not penny stocks are for you or a good fit at all. So hopefully you found value in this video. And if you haven't done so yet, make sure you smash that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.